In this video, we break down the mechanics of the poor man's covered call. The poor man's covered call, or PMCC, is a synthetic strategy designed to mimic the payout of a traditional covered call without requiring the massive capital outlay of owning 100 shares. Instead of buying equity, we substitute a long-term option, specifically a LEAPS contract, to act as our collateral. This effectively replicates stock ownership leverage while significantly increasing your return on capital. Structurally, the PMCC is a long-call diagonal debit spread. The setup requires two legs. First, you buy a deep in-the-money LEAPS call with an expiration of 12 months or more, targeting a delta of at least 0.80. Second, you sell a near-term out-of-the-money call against it to collect premium, exactly as you would in a standard covered call, reducing your cost basis over time. The primary advantage here is capital efficiency. If a stock trades at $200, a traditional covered call requires $20,000 in capital. A deep ITM LEAPS might only cost $4,000. Since you control the same 100-share equivalent, your potential return on investment is magnified. However, remember that leverage works both ways. A drop in the underlying stock price will hurt the PMCC percentage-wise more than the stock position. We rely on the Greeks we covered in Phase 3 to make this work. The long LEAPS has high delta, meaning it moves almost dollar for dollar with the stock, and low theta, meaning it decays slowly. Conversely, the short call has high theta, allowing us to harvest rapid time decay. We are essentially renting out an asset we control cheaply to collect rent. The critical risk to manage is the spread width. You must ensure that the width between your long strike and short strike is greater than the debit paid for the trade. If the stock rallies past your short strike and you are assigned, you do not want to lock in a guaranteed loss. Always verify this formula before entry. Thanks for watching, and stay disciplined with your risk management.